Welcome back everyone. Today we are going to have a same continuation of the chapter that we were discussing, that was the sources of finance for a joint stock company. Now you know the finance is the backbone of any business. Okay, the total business depends upon what? The financial sources. Now financial sources means what? The sources from where the finance can be raised. Basically in a joint stock company, raising finance is a big affair. That means you have to fulfill too many legal compliances to raise the finance in a joint stock company. Finance can be raised from internal sources, external sources. Till now we have discussed internal sources, that was issue of shares, both equity and preference, sweat equity of shares, okay, then bonus shares, plowing back of profit. External sources of finance, till now we have discussed what? We have discussed debentures. Okay, debentures is the biggest source of borrowed fund. Today we are going to see what? The loan from the commercial bank. Commercial bank are the banks are what? Those financial institutions which accept deposits and grants loan to the public. Here public means everyone. It may be a company, it may be a partnership firm, it may be a sole proprietor, it may be an individuals too. Okay. Now the question is that loan from commercial banks. Yes. Commercial bank, apart from providing short-term loans, it also provides medium-term and long-term loans. Short-term loans in the forms of cash credit or bank overdraft. Okay, but medium-term loans are provided for a period of 2 to 5 years. Long-term loans are provided for a period of 3 to 10 years or 20 years. And the loans which are sanctioned by the commercial banks are always charged against any assets. That means those loans are sanctioned after charging the asset. That means the assets are kept as a mortgage, and on the behalf of those assets the loans are sanctioned. Now there are certain advantages attached to the loans which are sanctioned by the commercial bank. Advantages in the sense, advantages from the point of view of a company, because the tenure, yes, the company gets a proper tenure of repayment. The loans are basically sanctioned for 3 to 10 years, okay, and then the repayment starts. Now repayment also, there is an advantage from the company's point of view, because repayment of the loan can be done out of what? The future earnings. In future, whatever the profit is generated from the funds which has been invested in the company, out of that fund, the company can make the repayment of the loan. The third advantage is what? Tax benefit. Yes, tax benefit. Benefit in the sense taxation benefits are there, because interest which are paid on the bank loan is totally deductible expenses as per the income tax laws now. And it is also a very cost effective method of raising fund, because you have to pay a nominal interest to the company or to the banks, and then the funds can be raised. No need of going for any kind of prospectus issues or any kind of other formalities which are attached with equity share, preference and debentures. Here certain legal formalities are fulfilled, and after that the loan can be raised. Basically, what are the legal formalities? The assets are kept as a mortgage, okay, mortgage with the bank, and the funds are released from the bank in the forms of loan. Now retained profit is also available when the funds are taken from the bank as a loan, because what happened? The company takes the loan, interest is paid out of the profit. That means when the company issues shares, the profit will go to the shareholders in the forms of dividend. But when the company is raising the fund, okay, on that fund the company has to pay what? A fixed rate of interest. The company has to pay what? Fixed rate of interest. Now with that fund, whatever the profit is generated is not going to be given to the shareholders. That part of the profit can be kept with the company, so that the company can utilize it in future for expansion or the growth of the business. Okay, and that is called what? Retained part of the profit. That means bank loan facilitates one major thing to the company, that the company can retain the profit, so that that part of the profit can be utilized by the company in the future course of action in the company. May it be expansion, may it be bringing some new technology, bringing some sophisticated machineries and all. But disadvantages are also there. When the funds are raised from the what? Commercial banks. Loans are raised from the commercial bank. The biggest disadvantage is strict requirements are there, legal requirements are there. The assets needed to be mortgaged. Without mortgaging the assets, bank is never going to give you the fund for a medium term or a long term basis. Financial burden, yes, interest on a bank loan is a charge against the profit. Even the company is suffering the losses. Even the company is suffering the losses. The interest has to be paid. The interest has to be paid to the bank, and it is the biggest financial burden. Reduce borrowing capacity. Once a loan is taken, it reduces the borrowing capacity. In future, if you require more loan, you cannot get, because borrowing capacity is reduced once the loan is taken. And variable interest rate, different banks they charge different rate of interest, and that becomes very difficult to determine what exact amount which is going to be paid in future, because the bank rates fluctuate, the interest rate fluctuates from time to time, and that brings a difficulty in deciding what is going to be paid in future. So this is, as in a nutshell, we can say that funds are required for a business. When you are doing a business, you need fund, and fund is utmost necessary for doing any kind of business. Okay, so when you need fund, you have to borrow from somewhere, or you can issue from your own sources, but funds are needed. So at the time of necessity, when funds are required, and that time the bank offers you the loan, that becomes the biggest boon for a company. Okay, what is needed for a sick person? A good medicine, so that he can recover from the illness. Same is here. Loans are, we say that there are drawbacks, but at the time of necessity, at the time of utmost necessity, the bank loan plays a very vital role to make the smooth going for a company. That means for a company, it plays a very vital role. Suppose a company is getting a big order from foreign, or a big export order is coming in the hands of the company, and the funds are not there in the hands of the company, or the company is thinking of expansion, the funds are not there. At that time, it plays a very vital role when the loans are taken from the commercial bank. So drawbacks are there, but you, along with the drawbacks, you have certain merits also, and merits plays a very vital role at the time of necessity. Okay, when we are going to come in the next section of the video, we are going to see regarding the loan from financial institution. There are different financial institutions. You have a State Financial Corporation of India, you have LIC, you have GIC, you have IDBI, okay, you have NABARD also. They all together play a very vital role in capital market, okay, because they give loans, both short term, both medium term and long term loans to the industrial sectors, okay, and they play a very vital role. And the loan which are taken from these institutions, basically very rare circumstances they don't get. Most of the time the loans are easily available, and such kind of loans are called what? Loan from different financial institutions. So hello students, now we are going to see the loan from the financial institutions. Now Government of India has established many financial institutions which are there to provide what? Medium term and long term loans to the different business houses, and in that joint stock company is also there. Okay, now to name the few financial institution, you can say IDBI or IFCI, Indian Financial Corporation Limited, State Financial Corporation of India. You have even LICs, GICs is there. They provide what? Loans to the joint stock companies on a medium term or a long term basis. Now, to take the advantages of these financial institutions, the loans or the funds are available at a reasonable rate of interest for modernization as well as expansion of the business. Basically, they provide for expansion and modernization of the business. Both equity capital as well as the long-term loans or facilities is available here. Okay, the institution also provide underwriting facilities. Underwriting facilities, what? The company's shares are sold on the behalf on, and they take the responsibility of the selling the shares of the company. Repayment can be made in easy installments. This is also one advantages of what? Loan from the financial institution. The credit worthiness of the business increases when the repayment is done on time. When the repayment is done on time, the credit worthiness of the company increases. Expert technical advisors are available, as well as not only technical advisors but advisors related to financial matters are also available. Okay, the institution can also make arrangement to import capital equipment from foreign countries, where sophisticated technologies or machineries can be imported on the behalf of the company. These institutions are particularly indispensable when a concern fails to mobilize the resources. Okay, and there these institutions, they provide their genuine concern to make the company available with all kind of resources so that the company can grow, the business can grow. So these are certain advantages which are provided by the loan, means when the company takes loan from the financial institutions. But drawbacks are also there. Yes, the financial burden is there. The existence from these institutions places certain restrictions on the autonomy of the company. That means they have to follow the guidelines set by these financial institutions, and that brings what? A restrictions. That brings a barrier where the company cannot operate on its own. And the financial institution retain the option of converting loan into equity capital. This is also a biggest drawback, that loans will be converted into equity capital. The moment the loan is going to be converted into equity capital, that is going to make those institutions part of what? The company's owner. And that is a big problem when the loans are taken from these financial institutions, because the ownership rights is transferred. And these institutions also nominate, sometimes they nominate their own directors so that they can have a control over the business. So these are certain drawbacks. Drawbacks are less, but advantages are more. Because see, fund is needed for any kind of business. It's a backbone of a business. When you need money, if you don't have any sources, you start begging. Yes or no? You start begging. Same is here. When you don't have any sources of raising fund, you will approach where you can get easy fund. May at a stake of your financial concerns. You have to accept everything when you need the fund. Acceptance is there. So loan from financial institution is also there in the market, where the joint stock companies can take loan and can meet their financial crisis. Okay. Now, apart from these all are long-term sources of finance, long-term and medium-term sources of finance. Now, apart from this, there are certain short-term sources of finance also. Short-term sources of finance deals with raising the money required for a shorter period of time, for say example, few days or to 1 year. You can say few days to 1 year. Okay. Short-term sources of finance is the bank credit. Yes. Traditionally, bank provided what? Short-term loans, and this the bank collected money from the public, and from there the bank provided bank overdraft facilities to the business houses. Okay, with a nominal interest is charged, and a limit is fixed. Within that limit you can borrow the money. That is a bank credit. Cash credit, this is the most popular form of assistance extended by the commercial bank to the business holder. In this cases, bank fixes a minimum limit up to which the company may borrow from it. That means what? The limit is fixed, and within that limit the company can borrow. Okay. Discounting of bill, this is also a way where the short-term financing is done. And revolving credit agreements. Yes, in the scheme the bank allows credit facility maximum limit without any securities. That means certain limit is fixed without any securities. You can borrow the funds and you can make use of it, and you can meet your financial requirement, and after that a nominal interest you have to pay along with your principal amount, which is going to be paid back to the bank. Then you have trade credit. It is also provided by the certain suppliers. They provide trade credit. That is also type of finance. When you are purchasing goods on a credit, you are making use of others' fund. That means when the suppliers are supplying you the goods on a credit, that is also a kind of what? Short-term finances for a company. Because instantly the company is not going to make the payment. The payment is going to be made after 2 months, 3 months, or within a year. But within that time, the creditor's fund is being used in the business, because the payment is not being made and the goods are being used, the raw materials are being used. With that, the business is functioning. So it is a type of what? Short-term finances also. So as a whole, if you see, there are different sources of finance in a joint stock company, both long-term, medium-term, short-term. And a company has a free of choice from where they can raise the fund. They can go by equity shares, they can go by preference shares, they can go by debentures also, they can borrow from financial institution, they can make use of what? Loan from the commercial banks also. And for a short term basis, they can have a bank overdraft facility, cash credit facilities, discounting of bills, public deposits is there, trade credit is there. So this is what then in the chapter. When you talk about the sources of finance for a joint stock company, you have one more thing, intercorporate deposits are also there. Intercorporate deposit. Okay, this I forgot to tell you. Intercorporate deposit indicates unsecured short-term funding by one company from one company to another company. That means one company gives the funds to the another company. The bigger advantage of intercorporate deposit is that the transaction is free from legal hassles. There is no legal hassles. It's totally free from legal hassles. Okay. And the rate of interest payable on intercorporate deposit or fund is lower than the bank loan. It's lower because it is based on, that means mutual understanding between the two companies. It is based on the mutual understanding between the two companies. Okay. And installment credit is also there. Many a times customers advances which are paid, customers when they pay advance payment to the company, that also becomes a short-term sources of finance because instantly you are not supplying the goods to the customers. Okay, you are making use of their fund, you are buying the raw materials, you are paying the workers, and then you are channelizing it. You are channelizing it into the production process, and when the goods are ready, then it is being dispatched. That means you are not borrowing from anyone, you are making the use of the advance received from the customers. So this is what there in a finance chapter for a joint stock company. Sources of finance chapter for a joint stock company. Okay, when we come next, we are going to have a discussion on a very new topic, and that is what? Banking latest trends. Banking latest trends. We are going to have a discussion on what? Banking latest trend. Till then, thank you very much. Take care.